The inflation boogeyman is seemingly everywhere, but is the fear justified? Hi, I'm Griffin of Derivative Logic, here to get you straight to smart. The latest gauge of inflation, the Core Personal Consumption Expenditures Price Index, or PCE, that's a mouthful, the Fed's favorite inflation gauge, remained elevated, growing at an annualized 4.5% rate last quarter after a 6.1% jump in the prior 3 months. Elsewhere, a surprise spike in the Employment Cost Index, or ECI, a wage gauge that's favored by the Fed, suggests that the pace of wage growth has also picked up briskly. Why should you care? Well, both the PCE and ECI readings will give the Fed some ammunition, as they'll likely soon make the case for more inflation urgency. These latest readings have also caused a rift between bond traders and economists, whose Fed rate hike expectations have grown further apart. In short, traders believe the Fed will hike rates twice next year, while economists believe liftoff won't begin until early 2023. Who's right? Well, we won't know for sure until mid to late next year, when the pandemic-ridden temporary factors that drove up inflation readings this year will have dissipated and the Fed will have mostly completed its tapering actions. The Fed's own inflation models suggest it will likely tighten earlier and faster next year if core PCE inflation exceeds 3.5%, it's 4.5% now, and full employment is reached, with the unemployment rate at or below 4%, it's 4.8% now. While one of the two pieces driving the Fed's calculus, that is, the improvement in the jobs picture, is kind of tough to map right now, we'd guess that inflation readings, the other piece, could rise higher if supply chain bottlenecks persist well into next year and prices for services jumps higher. For the week ahead, it's Jobs Week and Fed Meeting Week. This dynamic duo of events will take center stage and cast all other data and events to the shadows. During this Wednesday's Fed meeting, Chair Jerome Powell and company are expected to announce the start of tapering. That is, giving us the key details on the pace, timing, and composition of its plan to reduce its $120 billion a month in bond purchases. We expect tapering will begin in mid-December and that the Fed will have completed its tapering in June of next year. While a key piece of the Fed meeting this week, no doubt, everyone's expecting it, thus we doubt we'll see much movement in rates from the announcement. But the most important aspect of this week's Fed meeting? It's any signals the Fed gives about when rate hikes might follow its tapering actions. With price and wage inflation both running hot, the Fed won't give a specific time frame for sure about when it could hike rates. Rather, we expect it to state more outcome-dependent language, like, we'll hike when the unemployment picture improves, keeping any numerical thresholds vague and thereby preserving its option to hike rates as soon as the taper is complete. Again, likely around the middle of next year, should the jobs or inflation picture require it. From all of us at Derivative Logic, have a great week.